I'd like to welcome you all to the multifamily residential panel. We've got a great mix of panelists here with brokers and investor developers, and of course, the all-important lender. And what I thought I would do is let everybody introduce themselves on our panel, give you kind of a brief idea of who they are, their companies, and what they specifically do before we get going. So I'll start it off. I'm Gail Listner. I'm with Integra Realty Resources. We are a national valuation and consulting and research firm. We cover about 60 different markets throughout the United States and the Caribbean. I'm in the Chicago office. I've always had a particular focus on the housing market, whether it's, new development, apartments, condominiums, various types of housing. We're probably known locally in the market for the work that we do, tracking about 150,000 apartment units every quarter, both in the downtown Chicago market and in the suburbs. So where we're able to, kind of follow what's going on in terms of trends in occupancy, rents, what's going on in the pipeline, and it's very helpful for us in a lot of the consulting work that we do. So if we can just move down the line, and maybe we'll start with Milan, and you can give a brief introduction too.
Sure. My name is Milan Rubenstein. The company is Windy City RE. I own about 3,000 apartment units in the Chicagoland area. I also own in Texas and Florida and California. I run my company along with the construction wing, and we also own some office buildings, shopping centers, and a ton of retail. So that's it for me.
Hi guys, Jerry Lumpkins, Bank Leumi USA. I run the commercial real estate group here out of Chicago, covering the Midwest. I've been in commercial real estate for 25 years on the lending side. We focus primarily on multifamily, industrial, some office, some retail. I would say majority of the production that we've been doing over the past few years has been largely multifamily. So I'd say about 90+% of our production. Multifamily transactions range from 10 million up to 40, $50 million per deal. We can go higher if we just bring in some more banks to participate. I would say largely we're seeing a lot of value add, a lot of refinance cash outs with Class B, mostly workforce housing. So don't necessarily do anything in terms of large towers downtown, but it's largely neighborhoods or suburbs. So that's me.
Hi, everybody. I'm Joe Powers, the regional manager in the Chicago downtown office of Marcus & Millichap. Marcus & Millichap is a national investment sales and financing firm. We have about 80 offices around the country, about 2,000 agents, all focused on investment sales and mortgage banking. In Chicago, we have about 62 agents downtown, many of which focus on multifamily throughout the city. And I'm excited to be here.
Hey everyone, I'm Brian Karmowski. I work with Essex Realty Group. We specialize in apartment sales throughout the city and suburbs, mostly mid-market, anywhere between 6 to 300 unit complexes. I focus more so on the suburbs. I have a suburban team that I manage, and we're, if you're looking at a map, Waukegan all the way around to Northwest Indiana, and happy to be here.
Great. And then I also would like to introduce John. Could you tell us a little bit about yourself? He's joining us remotely.
Sure. Thanks, Gail. And good afternoon. John Prisbilla, work with Horvath and Tremblay. I'm also a commercial real estate broker, specializing obviously in the multifamily side. We do quite a bit of single tenant assets, as well as work with our clients on the 1031 exchange side. Our focus, we're downtown, opened up our office about 2.5 years ago, with a focus on the city, the suburban market, Northwest Indiana, and Southeast Wisconsin, and very similar mid-market private client type of product in terms of the content. So glad to be here.
Okay, very, very good. So I think what we see is we've got a lot of experience and some good diverse knowledge here on this panel. Thought I'd kind of start off with kind of what we've been seeing. I mean, I guess you can't help but notice, the impact of COVID on the market. It's, I think, been a really long 2 years. I kind of go back and remember how early on I was thinking about everything as pre-COVID. And then this summer, I thought we had really made it through, and I was kind of using the words, post-COVID. And of course, then all the variants came and the surges. So I think our lives are certainly still being very impacted by COVID and the markets too. So I think as we look back over last year, what do each of you think was like most surprising about the market? Were there any things that just took you by surprise in terms of what we've seen in the last year?
And I'll go. It's tough to just say one thing. I mean, it was a very, as I'm sure these guys can attest, robust year. I mean, Essex had about 250 million in sales between the city and suburbs. Occupancy levels across the board, and we do mostly B and C class apartment properties, were well into the 90s. Everyone I talked to, owner-wise, landlord-wise, wish they had more units to rent. And because of that, we had listings where there's 10, 20, 30 plus tours and 10, 12, 15 offers, very competitive process on each listing. So I think between that, just overall post-COVID, I don't know if I want to say post-COVID, but as we move along through this pandemic, just the demand for apartments is just sensational at the moment.
Yeah, I would add that as soon as COVID hit, of course, we adjusted our underwriting guidelines to account for the new scenario on the ground, and that meant lower advance rates. More frequency in reporting, financial reporting, arrears reports, monthly arrears reports, trying to understand, what the collections are like versus maybe a quarterly rent or semi-annual where a lot can happen between those intervals. So that was something that changed for us immediately. But to the point just made, I mean, we're that Class B, C segment as well. And yeah, there was a little blip for about 90 days where everyone's trying to figure it out, particularly with evictions and, trying to get folks evicted from units that began in January, February, and then everything stopped. And so, but for the most part, and our guys are experienced guys. I mean, these are 10 plus years. They're the Milans of the world, right? So these aren't like newcomers. They understand. They got a lot of units that they manage and own. And so they were just able to kind of work it out with their tenants in terms of there were issues, help them provide assistance in terms of what was available. But we didn't see any material dip in rent collection that impacted, our underwriting or project cash flow. What we did see, unfortunately, and we're still seeing today, and it's been mentioned throughout the conference, is the material increase in property taxes, which has been a tough thing to get our arms around in terms of underwriting and trying to peg what that future number looks like. And unfortunately, we've had some clients that have fallen out of compliance with covenants because of material increases in property taxes. We're seeing 50+% in some instances where, that largely is the reason why they weren't in compliance. And so lots have changed. But then again, I would say for the most part, it's been, given the markets, given the product type that we work with, it's been okay. All right. We've not seen anything that we had to put into workout or to charge off.
Sorry, Milan. One of the things I'll add to Brian and Jerry that surprised me, to echo Brian first, the transaction velocity has been through the roof. Values have gone up more than I ever expected they would, being a year and a half out of in a global pandemic. And to Jerry's point, the financing, the availability of financing has remained fluid. So that's helped our industry. The main thing that surprised me was the response from out-of-state capital about Chicago. As a national firm, we talk to a lot of investors from all over the country, and despite what you read in the papers and in the headlines and all the challenges that we're aware of in Chicago, we've still seen a fair amount of out-of-state capital look at Chicago and they view Chicago in many ways as a value play. Whereas, if there's certain investors that might look at Atlanta or Nashville or Denver, you could get a much better return in Chicago, specifically from coastal capital. I would say more so on the East Coast and targeting the South Side. So that was one of the biggest things that surprised me over the last, call it, year and a half.
Yeah, I was gonna say that what Jerry said about property taxes, because I own a lot of commercial, multifamily stayed, even though it increased, it stayed kind of low compared to commercial. They doubled my, in some cases, they doubled my property taxes. So my collections are lower than the property taxes in some cases. So on a commercial side, they decided to double down and really go hard on the property tax. So the values of commercial property, all the mixed use and office, retail tremendously went down, and apartments stayed, like these guys said, super strong. What I'm surprised about, I built a big fund with my investors to buy foreclosed hotels. That was what I was betting on, and I was not able to buy a single hotel to convert into apartments. And that was a big thing. About a year ago, we all thought, oh my gosh, now COVID's gonna kill the hospitality industry, and I'm gonna be able to pick up a lot of good deals on that side. And I wasn't able to do any, not even one. So I shifted my focus to Airbnbs instead and short-term rentals and some similar, more tech-enabled new rental projects. But and one more thing, I was going to say that typically, when you have a downturn, the A locations don't get touched. So it's usually the C and D and B sometimes that take a dip. So in 2009, 10, 11, 12, I picked up buildings by Wrigley Field. In Pilsen, I was buying buildings at 40, 50,000 a unit. Now I'm selling for 200 plus, 250. So that hasn't happened, obviously. But downtown, I just closed on a deal a couple of weeks ago, 117 East Bellevue, 5 units I bought in Gold Coast for $1.8 million. I mean, those downtown buildings that I'm picking up now are at a discount. And I wasn't expecting to buy A locations in downtown Chicago for those prices. So those are the 2 areas that I'm most surprised about.
And how about you, John?
Yeah, just echoing a lot of the comments there. To put into some content, over the last 18 months, we've sold 1,500 units. So it was an average of about a 25 unit building. So that's kind of our focus as well. And not many of the buildings and the clients really experienced any issues with tenant retention, occupancy, and pretty decent rent collection. Obviously, there were deals that were made to keep those tenants in, but those decisions were made on the fly. Some of our larger buildings and clients that we dealt with, they had more of the issues with so mainly on the rent collection side. They weren't bad, but they did experience that more than that smaller unit size. The other thing, we were talking about this earlier this week, Gail, is of those sales in the last 18 months, historically, some of these owners that have owned for 20, 25, 30 years that have been called over and over again by brokers and buyers. And they've always said, I'm not selling. You're going to have to get me out of this building in a box feet first. A lot of those owners last year transacted because of what we just went through in terms of the pandemic and really the ripple effect on that. So I thought that was a big difference. And then some of the buyers, we've seen this over the years in terms of different generations and what they like in an apartment. But unit mix and unit size, I think, is coming more to the forefront with the work from home. We have a 3-unit or a 3-property portfolio in Mount Prospect that was built in the 70s, all 2-bedroom, 1-bath units, and they have an eat-in kitchen and I'll call it a formal dining room. And all those units are being used most of the units are being used as work from home. So it's becoming an office. So, I think that's changed over the years with just some of the renters' demands, in terms of amenities. They're still big in the bigger properties, but, I think those common area spaces with the pandemic have been a little bit, there's been concern there. So package rooms, things like that. I've seen a big change. And then really just the way we've seen buyers very similar. We have a very heavy East Coast presence with offices on the East Coast in Boston, New Jersey, and Florida. The way buyers are looking for deals historically, it's been with the relationship of a broker making phone calls, but CoStar, LoopNet, Crexi, the amount of activity online right now, obviously, which came to a head in 2020 with everyone staying at home. Tremendous just access to those buyers through those services.
Interesting. And I would say from my perspective, probably my biggest surprise was the dip that we saw in pricing in the downtown market, where occupancies, dipped into the 80s. And I was talking to buildings that were in the 70s. I had never in my entire career seen, good quality buildings in the 70% occupancy level. And, rents had dipped so much. And then it just shot back up so much faster. The recovery was so much faster in 2021 than I had ever imagined, because I think it was on the anticipation that people were going back to their offices. And so the apartment market kind of got ahead of that. And it's amazing to me because the people still aren't back in their offices, but the occupancies downtown have gotten so strong and have actually stayed strong. So
I think, Gail, too, is that they just got tired of being back in their parents' basement, right? I mean, 'cause we saw that too, right, initially, particularly with downtown. If you're like a studio or one bed, and now you're confined to that unit and all your amenities are shut down, the restaurants, the theaters and all the amenities that while you're downtown, I mean, you want to get out and have green space. And so we did see a lot of increase in occupancy for our suburban, garden style apartments. And, you're downshifting from a class A to a B minus, but that's okay because you got outside and you've got more amenities. So,
yeah, no, true. And the other thing I saw was that, the first time ever I saw real weakness in the studio market downtown and on the north side. And that was a market that, I always felt it's a price point renter. You can always keep those full. But they were actually able to rent a one bedroom at the same price that a studio normally would have been priced at. And so that was a huge thing. So we were talking about it. It's a great year. We've seen a ton of transactions. What else is motivating these sellers now, these owners to sell? I mean, do they think pricing is peaking at this point? Are they getting old, or what do you all think?
I can chime in quick on that one. There's only a handful of motivating factors that tend to cause people to want to sell. And a lot of times it's price. And if you look at the cap rate compression we've seen over the last, 5-10 years, and, the way that rates are, if we see rates continue to spike up, it's a pretty easy calculation to make that, you're probably not going to see any more cap rate compression. So I think there is a lot of profit taking, Gail. And I think the other side of it too is, one of the objections you hear often from someone who isn't predisposed to selling is, well, what do I do with the proceeds?
Yeah.
And the net lease market has become so attractive to investors who are at the tail end of their investment cycle, where maybe they're tired of the management, they're tired of collecting rent and tenants and toilets and all those things, where they can take their proceeds from a multifamily investment where they're selling at the top of the market and deploy that into, a 10, 15, 20-year lease to a credit tenant where they're collecting a check every month. And a lot of times that income, if they leverage properly, can be the same as their cash flow that they're receiving on their multifamily assets. So I think people are becoming more open to that. And that's one of the trends we've been seeing a lot of, more so over the last 18 months.
I've also seen too where the most successful transactions have taken place on a sale basis is a long-term ownership, like a 30-year-old family that's
they've owned it and it's kind of been an annuity, right? And they've not really touched rents because they like the tenancy and they like the community that they develop. And so now they're ready to retire or to go into something triple where they're not dealing with trash tenants and toilets, right? So, and so it's, that's where I've seen most of my clients experience a lot of success, where the deferred maintenance at the property level, the rents are, $200, $300 below market. And the guys can come in and immediately execute their plan and add a lot of value. So I've seen several transactions on that basis.
So I have about 3 or 4 guys that just call all day long for me personally, and I'm not seeing any deals out there whatsoever. People still want to sell. There's nothing to go exchange into. The alternatives, the deployment of capital are very scarce. I mean, there's nothing else to put money in. So a lot of money, they printed $4 trillion, 20% of every dollar in use right now is printed last year. So just a lot of liquidity out there. So no deals, obviously. But again, even though I was, what was it, a week ago, I was attacked in the middle of a street in Gold Coast and still have 7 stitches in my upper lip right now. I'm buying downtown as we speak. I'm buying 10 single family homes that, one in particular, 1150 North LaSalle, was listed for 3.6 million. I picked it up for $1.625 million. I think it's a good deal, 6,000 feet. And so I bought.
It's an amazing deal.
Oh, that's my job.
I'm more curious how many stitches, I'm curious how many stitches the other guy has.
I just wanted to say that there's always an opportunity in every market. So these single family homes, people are running away from downtown right now and buying those. Back in, in 2009, my minimum purchase was 10 million plus. In 2010, 11, 12, and 13, I was buying single family homes for 150,000. So again, I bought 70 homes in 2009, 10, and in 2005 to 2009, it was 100 plus apartment units. So you have to go with the market. You have to go with the deals on.
Yeah, we're seeing, I agree with Milan, some of the supply and demand imbalance out there. But there are opportunities, like you said. Now, some of our investors are looking at Northwest Indiana. On a good day, you can access those markets from the city. Obviously, the suburban market, and then Wisconsin as well. We're seeing opportunities there, but I definitely agree that sellers are making decisions based on pricing. That pricing has never been as high as it is in pretty much every market. But other issues, obviously, that were hot buttons and still are. Your Chicago taxes, Cook County taxes, that owners have been talking about for years. And I don't want to say complaining, but definitely have been talking about. But they're now making decisions to get out of Cook County. A lot of dollars are flowing into the single family residents in bulk. Okay. Not only here in Chicago, but a lot of our Chicago people have places in Florida. So Florida, other states that, are more tax, friendly, if you will. And then your traditional drivers. But yeah, pricing is definitely on the forefront of why people are thinking about selling.
So if somebody wanted to keep track of how many times we mentioned real estate taxes, I think that will certainly be the central theme, or one of the central themes today, anytime we talk about Cook County, because obviously it's kind of front and center in every buyer's mind. So how are you finding that the buyers and investors are kind of underwriting these deals, and what are they projecting, and what are you projecting when you're doing your pro formas, whether it's for sale or for your own deal or lending on them?
Yeah, I think it's highly dependent on location within Cook County or County or DuPage County. In the collar suburbs of Cook County, you could be around 12, 13% of gross income, or you could be as high as 20, 22% in Oak Park, Forest Park. It really depends. Once you go out to Lake County, DuPage, they're a little bit more predictable. The taxes, they usually increase 2-3%, kind of along with inflation, well, standard inflation. Usually it's around $2,000 a unit a year, depending. And this is B and C class stuff. Obviously, if it's newer construction, you're closer to 3, 4, 5,000 a unit a year. It's tricky. It's obviously it's a common theme throughout this morning's discussion, and we'll see once these tax bills. I know assessed values are starting to come in, and they're scaring a lot of people. But on the in the northern suburbs, Evanston, Glenview, when they first came out with the assessments, they were significant, 50, 75, 100% increases. And after the Board of Review, they got them down on average. I mean, this is on average 25, 30%. And the net increase to the tax bill was around 20%. So people aren't really quite sure, especially in Cook County, where things are going to shake out. And that's what they mentioned this morning, which is affecting investment in Chicago, is the uncertainty. They don't really know how it's going to shake out. The suburbs outside of Cook County, again, are a little bit more predictable. But it's an issue, and it's probably the most scrutinized line item in our underwriting.
Are you finding that it's easier to sell a deal that's outside of Cook County at this point, or?
Yes, yeah. There are clients that reach out, weekly that say, "Hey, I'm interested in suburban apartment, but I don't want Cook County." So that's creating a lot of demand in these, collar counties. And it's a huge driver. But despite the taxes, there's still an incredible amount of demand for apartment buildings, both in Cook and Lake, DuPage, Will, Kendall, Kane, because of all of the jobs, all of the industry that we have here in Chicago. And I know we have our fair share of problems, but there is rent growth, there is population growth. Obviously, it's not to the extent of a Phoenix, a Texas, or a Florida. But it's a stable job market where rent growth has persisted, and occupancy levels are high. Everyone's well into the 90s, and collections are well into the 90s. So again, despite the headwinds, there is still a lot of investor interest in the Chicago area.
One of the things I'll offer from an underwriting standpoint is that if it is Cook County, we are stressing those taxes pretty significantly, just to ensure that the cash flow can cover it, right? Hopeful that it doesn't get there, but at least we've run the scenario that a tax bill has increased 50%, knowing that our borrowers will repeal the taxes and get them back to some level of normalcy. But in the interim, they still have to pay that bill, right, until they get it back to hopefully somewhere historical. But we're doing that, and that's the
Is your
first thing.
competition also the guys you're competing with for?
Look,
for
I mean,
these loans?
my most traditional bank, I would say yes. I've worked for a lot of banks, and so I know how these guys operate. But if you're not doing that, then you're doing yourself a disservice, particularly if it's Cook County. You've got to look at that. And normally, historically, we've seen 10% of EGI in terms of that expense level. And we might bump it 5% or something just to kind of stress it. Now it's like, depending on where it's at, it could be 15 to 20% of the EGI. And God forbid it gets there, but we've seen it get there. We've seen it on an actual basis get there. Hence why some borrowers have fallen out of compliance with loan covenants, largely because of that line item.
I'm going to offer a different perspective. When I look at the deal, I actually don't think about taxes that much. I do plug in more just because it's a responsible thing to do. But I look at the price per pound. I look at the price per square foot first. So if you're buying a value add deal, who cares whether the taxes are going to be increased? They're not going to be increased that much. And I'm paying more in California. I don't have rent control. So you can argue that we're blessed that we are in the Midwest where people are nice and pay rent if they can and not trying to screw you. And, like my tenants in other parts of the world. So I am looking at the good deal and I'm looking to buy it right. And then everything else falls into place. I just closed a deal in Panhandle, Florida. We made $12 million on it because we bought it right. We bought it at the right price. And so I didn't even look at the taxes, although taxes are not an issue. there, I'm just giving you that as an example. If you buy it and add value, the taxes will not make that much difference. It's just when you're underwriting a Class A deal or a deal that you're just buying at a 5 cap for cash flow or, things like that. Those are the buyers that are affected by it. And that's why we have capital coming outside of the state, is because if you're looking at New York and LA, this looks great.
I think, Milan, you're more opportunistic than people buying some stabilized assets as you.
Yeah, and that's
as you
exactly
said.
spot on. I mean, it's
Yeah.
on a value add scenario where you on day one, you have value, right? You've created equity and you've got to hit that pro forma once you execute your business plan. But for those stabilized deals, they're just trading hands and someone's just looking to collect a coupon. We got to laser focus on the real estate tax line item.
Right. So John, when you're kind of taking a building to market and you're looking at the income stream, I mean, how are you projecting your rent increases? And are you looking at kind of the trailing 12? Are you looking at the last 3 months or the last 10 leases? How do you look at?
Yeah,
the
sure.
income?
Yeah, sure. But that, to me, that's where, and again, our focus is kind of on that, 6 units to 30 unit number. I gotta say, every property and every client that we meet with talk about value add and upside, because that's what the buyers are looking for, is on the rent side. For whatever reason, it is a strategy that a lot of the owners have, that they're more concerned with potentially occupancy than rocking the boat and moving the rents. So what's been nice is there has been turnover in the units, and so that last rent or those last 3 rents that were signed are definitely above what the average is, not only in the building but sometimes in the marketplace. And the buyers want to know that, that number that the broker puts out there on a pro forma basis is actually real, and not, just to get you, to get the cap rate higher. So they are looking at, the trailing, however number of units have been rented in the last 3 to 6 months. On that property we had in Mount Prospect, the seller called me and said, we rented out the below grade unit. It's half below, half above. That's the product type. And then 2 floors above that. And he said, you're not going to be happy with me, because I got more for that unit below than a month before on the 2nd floor unit. So, rents are trending in the right direction. So, I think you really need to be dialed in as a broker to help those buyers to understand where there's more value add, other than buying it. And in terms of the rent upside, there's very little you need to do on a CapEx basis. I mean, there's things you will do, but that's how we are underwriting it. And then on the taxes, again, it is a hot point, but how many properties were sold in Cook County and Chicago last year? So buyers are still buying it. Like Milan said, they'll make the deal work. They fight it. They have to appeal the taxes, but it's not deterring the sales in Cook County.
So how do you guys, I have a question real quick. How do you guys underwrite the construction nowadays? Like for clients, or what do people, because we all know the construction prices went up tremendously, right? So if you're pricing out a new deal, Jerry, how do you do that nowadays?
I mean, I'll be honest, we're not doing any ground up construction right now. It's just one, we don't have the capacity to do it at this point in time, but I mean, we're doing largely value add. So not taking it to the studs, but I've seen some, I was out in South Bend last week, that's down to the studs. Yeah, we're just all the variables that are involved right now. We just prefer to kind of stick to light value add to refinances and acquisitions.
Yeah, are you all seeing that value add is driving a lot of these transactions? I don't know if you're able to put them in different buckets, but kind of the stabilized deal, the value add, or are some deals that you bring to market could be either? I mean, do you know when they're value add and when they're kind of stabilized? Or do different buyers look at them different ways?
I would say, if you were to classify the market into, let's call it vintage versus new construction, there's an incredible amount of demand for both, but I would say we're actually seeing tighter yields on the more vintage assets, I think because of the value add component that they offer. We actually had a client who recently sold a vintage building in Lakeview who traded into a new construction building on Lakeshore Drive because it was just newer, less work that needed to be done, but he was actually getting the same return. So you can actually get a better return in some cases on newer construction, non-value add than the more vintage buildings that offer value add. So I'm not sure if that answers your question, but it's just an example.
Yeah, I think there's, to Joe's point, there has been an incredible amount of cap rate compression with value add deals to the point where investors are now looking at something that's a little bit more stabilized, where they're not going to have to spend 30, 40, 50,000 plus a unit to rehab it and get those rents. They're like, why would I go through the brain damage when the capital markets are giving me rates at 3 3/4, fixed for 5, 7, 10 years, maybe some IO on the front end if it's through an agency. And we're seeing a lot of that. It just depends on what the investor, what their goal is. If they want to do a value add strategy and they have the systems in place to do that, and they can recycle the capital and get a lot of their money back upon a refi, or if they just want to put some money to work, given all the tax advantages, et cetera, with multifamily, and they can get really, really good debt at the moment. So we have seen more stabilized deals that, maybe there's some loss to lease, but that's, relatively easy to overcome versus the value add deals. So both types of deals are garnering a lot of attention at the moment.
Yeah, anecdotally, Milan, what I could tell you is even though I'm not doing it right now, I'm getting calls all the time, every week, to provide financing for construction. And, Lumi, we're headquartered out of New York. We have 4 additional offices, Miami, LA, Chicago, Palo Alto. We're doing construction out in New York, and we're doing construction out of LA. We are potentially looking to roll out construction later this year out of Chicago because, again, of the amount of demand that we're getting. And to your point, you got guys calling all the time, and they're not finding deals. So it's like guys like, shit, I might as well build, if it makes sense, right? So we want to be in a position to take advantage of that. But yeah, it's tough to do right now in terms of.
So I'm doing a few value add deals right now, smaller and bigger, 12 units to 600 units. But my issue right now is, we're always pushing these rents, value add, push rents. I would say that on a small building, I just bought 12 units in Addison. 3 out of 12 units, 2 are paid by the HUD and 1 is paid by Catholic Church. So, when does the music stop at some point? And, we're not going to get these vouchers anymore. These COVID helps from the city and everything else. I would say that 30% of America comes in now from third-party sources. So that's going to be an issue coming down the road.
Yeah, interesting. Are you still doing any like adaptive reuse? Like I remember those deals you did in the South Loop. You did some rather large ones.
Yeah. So I did a lot of adaptive reuse, and it's an interesting question because I even looked at, converting office into apartments. 105 Madison, a high, mid high rise I own there. I bought it to convert it into apartments. Now, I think that people are starting to look again because that's the softer product type, right? Office. And I'm getting a lot of calls. Hey, I want to buy your building. I want to convert it into apartments. So I am not looking at adaptive reuse because of the construction costs. I'm not willing to bet on, steel went up double, the wood prices. I mean, everything went up. The material just is not available. You go to IKEA and try to buy a kitchen, you'll wait 6 months. I mean, things are not available, and people don't underwrite. The owners don't underwrite carry costs well, and that's what kills you. On my $14 million build out of 2036 South Michigan, I had $2.5 million carry cost. So, now if that would have been 6 months later, it would have been another 900,000. So I'm not looking at adaptive reuse because of the construction costs. I'm afraid of them. And there's no labor. I have my construction crew and I'm spread thin. Finally, the office tenants came back in the fourth quarter. Right now, I'm getting 3-4 leases. I have going
In the
with the
loop?
TI. Finally came back a little bit, but I just can't find laborers. I mean, everybody that was at 15 to 17 now is at 25 an hour. I mean, I'm having a hard time. People have COVID. 40% of my crew has COVID right now, so I'm just having a hard time with labor and materials and everything.
I mean, that's exactly one of the reasons why we're cautiously entering into construction, everything you just outlined. I mean, in terms of labor, in terms of material costs, in terms of being able to have material delivered to the site, in a timely manner. Folks having to wait 6 months, 9 months to have cabinets and appliances delivered. I mean, did you factor that into your timeline when we did the initial budget? In many cases, they did, right? So there's 20,000 different ways to get into trouble with ground construction, and I've done it in my past, and so we're proceeding cautiously on that front.
Okay. What kind of financing are you all seeing kind of typically on these transactions? Maybe we can start with you, Jerry. I mean, how are most of these transactions being structured?
Again, it's going to depend on first and foremost, the sponsor. I mean, that's where it all starts for us. I mean, it could be the greatest deal out of the box, but if the sponsor doesn't have any experience, very little, it's probably not going to get done with me. Our sponsors normally have 10 plus years of experience in the market in terms of what they're dealing with, particularly with multifamily. They have some liquidity, they have some material net worth. So we start there, right? And then, of course, we look at the deal. For if stabilized property, not much need to be done. The guy's just buying it to collect a coupon. I'll do 75% of that purchase price, 30-year amortization. Rates today are going to be in the low to mid 3s, on a 7-year kind of fixed term basis. It could be sub 3 on a floating basis. Again, depends on what the play is, right? A lot of guys prefer to come to me versus the agencies because they can call me and they've got a lot more flexibility, and there's whether in the event of a resale or sale of the property, partial release of some collateral, they're able to deal with me specifically. And so
You can negotiate that to 0 points on a sale.
you can, absolutely. Spoken like a guy who knows exactly what he's doing. And we do that. We'll do that. What we do though is give me those sale proceeds, right? And let me do that next deal. So again, and at that leverage, we're going to require recourse, right? And so, it doesn't necessarily need to be 100%, but it needs to be material. We can go to a non-recourse basis if the leverage is, say, call it 65% or less, right? So you can have a burn off kind of scenario. And light covenants, might require $1.25 on the DSC and some, periodic financial reporting on the property as well as the guarantor. So so on a value add, I might be maybe 5 percentage points lower, like 70%, right? In terms of loan to cost, in terms of, because you got to buy it, and then 2, you got to execute your value add plan, which can be 18 to 24 months to do it. And I might 70% on the front end and then give you some good news money on the back end if you executed on the business plan and stabilized it. So, and that's been very, very successful for our shop for the past 24 months. So
Interesting. Is there any urgency in the market to get deals done because of the potential uptick in rates that, we keep hearing
everything's-
about?
Absolutely.
everything's an urgency. Everything.
Yeah.
But then it's like, hurry up and wait, right? It's like, I gave you a term sheet on Christmas. What do you mean you're not going to sign it yet? So.
And I've been wrong since 2008 predicting that the rates were going to go up. So don't please listen to me. But yeah, I've bet on rates. I got locked in rates with CMBS market in 2009, had like 6.5% and then went down to 4. So I'm now taking a floater, which is, probably the mistake. But that's what I'm doing, all the floating rates at sub 3. And like Jerry said, it's really important to have a relationship with the bank. Because at the end of the day, when things are not great and rosy, like right now, they want to do business with people they know and they feel comfortable with and they've performed. So if you're a brand new investor or brand new in the market, start with one bank and don't shop for 5 basis points, 10 basis points here and there, because, certainty of closing is more important.
Yeah, I could tell you too, we've had a lot of success, not a ton, I should say, but we've closed a material amount of deals where guys are floating, right? And because of the sub 3% interest rate, right? But I also provide the ability to fix it. So as rates begin to tick up, say we do a 7-year deal, you're not going to float for 7 years. I know.
So
that.
during the course of the
So, but
loan.
it might, and I may build in, hey, look, I'll let you float for 3 and let's convert to a market rate after year 3. But during that period, 3 years, rates really start popping up. Then we're talking about lock it now versus waiting until the end of 3 years. So that's another kind of a competitive advantage that we offer. But to Milan's point, I've been doing this 25 years. I've never been successful in projecting where interest rates are at. If I were, I wouldn't be sitting here talking with you. But the Fed is forecasting at least a couple bumps this year. So we'll see. We'll see. We from an underwriting standpoint, we built that in already. So I'm not underwriting to what you're closing your rate at or your deal at. I'm probably underwriting to a 4.25 interest rate just to make sure you still cover.
Is that driving any urgency on the part of sellers or buyers to get deals done at this point? I mean, because, I was listening to the radio yesterday. I was driving around looking at properties and I heard one person saying, I wouldn't be surprised if there were 8 bumps, by the Fed next year. So you hear all sorts of things out there in terms of what people are projecting. So does that drive things, or we're at such a low level for rates anyway? That it doesn't.
I would say it drives urgency and activity. I mean, it's one way to look at it, but if you were to compare the average cap rate to the 10-year treasury over a long period of time, you can see there's somewhat of a correlation, right? It's not 1-to-1. It certainly doesn't react immediately, but if you do look at it over an extended period of time, they correlate. And if you look at the spread right now, I mean, I think the 10-year is up to like 1.7 today. Right. Versus what was it like a week ago, like 1.4, something like that. I mean, it's spiked, but that's not going to have a huge impact today. But if that continues to trend upward and the spread between the cap rate and the 10-year, relative to interest rates start to tighten, that will have an impact on value. And if you are at a stabilized point in your ownership cycle where you can't raise rents and you can't raise occupancy, you risk leaving money on the table if you're not selling right now. Now, that's not to say everyone's in that boat, but if the 10-year does rise and, you can't raise income, it will have an impact on value.
Yeah, as people are looking for product to sell, I know one source of potential product has been condo deconversions, and I think a couple of the panel members are active in that. I think Brian you've been doing a bunch of those.
Yeah, Essex has done quite a few in the city and in the suburbs. It's really a product of supply and demand. I mean, there's just a lot of demand for apartments throughout the city and suburbs, certainly larger, your 40, 50, 100 plus unit deals. And because of that, these deconversions have come into vogue and something of interest to a lot of investors. It is a lot of work, certainly on the front end. In the city, they raised it to 85% approval. I think that was last year, the year before. So it's a little trickier, although they're getting done in the city. In the suburbs, they've certainly picked up in popularity because it's still, for the most part, 75% approval. So there's a lot of meetings. There's a lot of town halls to get them done, but I'm working on a few now in the suburbs, and they're trending in the right direction. It takes a while to get all the owners on board, or at least 75% of them. And they're definitely coming around. I think lenders have become more and more comfortable with the deconversions. You know, a lot of these buyers get some sort of construction bridge debt that does float for, 18, 24 months while they turn around and try and rehab the units and get the rents up and deconvert it to a stabilized apartment deal. And the values there, at least in the suburbs, there's probably a 20% discount to buy a deconversion versus buying a standard apartment deal.
So is that 20% discount, is that when you have full control, or is that if you're like only getting 50 or 60% of the units?
I would say if it's under the 75% threshold in the suburbs, it's probably a greater discount than 20%. If you
Okay.
do have the 75% and you can deconvert it, it's, right in that ballpark, depending on the location and the condition of the property. Whereas, 200 unit deals in the suburbs are trading at 5 caps, sometimes sub 5 caps on trailing numbers. So it's an opportunity for an investor to go in there and get a deal if they're comfortable with the process and all the work to really get some good value.
Yeah, to that point, there's a lot of work. I mean, we've done a handful,
Yeah.
we've done a handful, even when the bank finally gets involved, it's a 6 minimum month closing timeline up to a year, right? So that's, you gotta just know that, build that in, that deal's not gonna close within 60 to 90 days. And, we've seen it out in the burbs, more frequently than in the city. It's funny because I've been in this business long enough where prior to 2008, it was the other, where people were converting, newly constructed apartment buildings into condos. And I'd go to these properties and I go, this is a freaking apartment building still. It's not a condo, but that's what was happening. Now it's going back the other way. But you can't do too many, from a banking standpoint, we can't do just too many of them just because it gums up the process. It stays in your pipeline and it doesn't close out efficiently. And then of course, anything could happen, right? You can have an owner sue and stop the process. You can have an owner die and then the state stops the process. And then we've had owners disappear and can't find them to give them a check. And so it's so it will run the gamut of just comedy of various things that will happen. So they're kind of fun. They're now fun to work on because we've done a few of them, but a lot of work.
Yeah, and in 2009, my very first deal in Chicago was in Mount Prospect. It was about, 500 units. I think I bought it from Essex. And it was a condo deconversion. And I was calling every bank I could possibly find in, Yellow Pages. And basically, yeah. And
What are those?
and I couldn't find a single bank to finance it. Not a single bank wanted to finance the condo deconversion. And to the credit of Wintrust, Hinsdale Bank, they actually understood the deal and believed in me and did it. And I stuck with them to this day. But right now it's a lot easier to find a bank that will understand it. Same thing with short-term rentals. Even a year ago, I could not find any single bank who want to touch Airbnbs. Not at all. They all said this is a terrible idea. This is horrendous. We don't want to touch it. And now I showed them that we grossed $3 million on 50 units, and they said, "Oh, this is a wonderful idea. We'll finance it." So.
Yeah, we were saying the same thing. I mean, I'm the bank here, right? So you brought an Airbnb deal 2 years ago. I'm like, give you a Heisman on it. But now it's like, okay, yeah, it's great. It's an amazing source of income for you. We don't want too many of them in the property, right? So we want to make sure that we control that because we don't want a transient kind of tenancy coming in and out of the building. So that's one of the things. But two, now we just understand it better. So that's why we see that tremendous amount of upside that you're getting because of these units. And so we allow for, but not too many in one
What's
property.
the problem with the transient type of house?
Do you discount the Jerry?
I've lived in a property that had an Airbnb, the 3 o'clock in the morning parties. Come on.
Yeah. Do you discount the income at all for short-term rentals?
We do.
Yeah.
Because, we look at it
Kinda have
also, what does it look like just from a traditional
Apartment.
right?
Yeah.
And so the Airbnb is just gravy. I mean, it's just extra. It's perfect, great. You're
Yeah.
getting it and it's actual. But if we were to take the property, God forbid, I mean, we would be doing it as an apartment building.
Gotcha.
Understood. So just to answer how I deal with it is I take like, there are bigger companies that do it like Sonder and all those companies. So what we do is we take over the whole floor or whole building. So, obviously there are restrictions. You can only do up to 6 or 25%. It's a lot of legal hurdles still, but yeah.
Is that a lot, Milan, is that a lot in Chicago or is this nationwide for you?
This is just in Chicago. I'm expanding now in other states. But in Chicago, it's better than in New York, for example, but it's not ideal. I mean, it's not great because of all the issues that, people have with Airbnbs, but at least they are dealing with it in some, in some way where they tax us like hotels, 31%. So
Sure.
that's a smart way of handling it. But then there, you can only do up to 6 units. So, I have a 68 unit building on Michigan Avenue and I can only do 6 units there. It's 25% if you have a 7 unit building, you can only do 1. So that's unless you get a hotel license.
Yeah, but it certainly is a creative way of generating, I guess, some extra demand that we wouldn't have seen otherwise. In terms of other types of ways that people are looking at appreciation and where the best growth is, are there certain neighborhoods that anybody's seeing, or south side, north side, suburban? Are we seeing any trends there? And how about around the Obama Presidential Center? I always am getting calls from people who own properties near there, and they keep saying, well, what are you seeing? What are you seeing? Anybody doing work around that area?
You mentioned the Obama Library, which is such an incredible asset to the city. We just sold a building about 5 blocks from there at the end of the year on Stony Island and 65th. And I think we sold it like mid 6 cap, let's call it. Milan, I'd be curious to get your opinion. In 2, 3, 4 years ago, that'd probably be 8 cap, right? I mean, so the cap rate compression due to the demand on the south side, largely from out of state capital, as I mentioned earlier, from New York, New Jersey, but also because of an asset like the Obama Library that's just drawing more people down there. And so, yeah, to answer your question, we're seeing a lot of compression down there. Not as much on the north side. And from what I've seen, values have remained somewhat flat.
Right.
But yes, on the south side, we're seeing compression.
Yeah, I would say that too. I mean, we're seeing certainly a lot of interest from coastal investors wanting to invest on the south side, west sides of Chicago. For me, those aren't my guys, just because they're spreadsheet investors, chasing yield. My guys are local guys who know the neighborhoods, know the tenants, know the mechanicals of the buildings, know the warranties and things like that. So those are the guys that we tend to stick with. But in terms of your question regarding, interest outside of the city or suburbs, I mean, absolutely. I mean, we're seeing folks who are going out as far as Rockford. I've done probably $100 million of transactions in Rockford over the past 5 years. Quad Cities, I just closed something 3 months ago in Moline, an apartment building. Peoria, folks are beginning.
You're doing a lot of mileage on your car.
They pay me to do it, but no, it's in it, and they're solid markets.
Yeah.
Class B workforce housing, 90+% occupancy, and I mean, it's probably 6.5 to 7.25 cap rates on those markets, and so those are great markets too.
Yeah, I think I'm biased towards the suburbs given what I do, but I think a lot of the suburbs have experienced double-digit rent growth in the last year. I think it's a product of COVID, obviously, but a lot of people, demographics with families moving to the suburbs, and they don't really want to buy a house quite yet, or have any interest in buying a house with all the costs and taxes. And I across the board in the suburbs, I think last year, if the landlord was ready to get aggressive and was more comfortable with COVID, they were seeing 5, 7, 10+%, depending on where the unit was, to start rent growth throughout the suburbs. So think that will continue, maybe not at the same clip, but it'll be interesting to see. I know I'm kind of going off topic here, but inflation, it's 5-6%. We'll see if that continues. And there is, to Milan's point, a lot of money out there. There's a lot of money printed last year. We'll see if that has an effect on rents. But I think overall, in talking to just about everybody in the business late last year and early this year, most people are quite bullish.
Yeah, and this is exactly how 05, 06, and 07 felt like. And, I drove to Rockford myself to look and I hated it. And I'm buying a deal that Gail is appraising right now. And DeKalb, how many units is it? You know better than me. I'm buying over there.
What was the number? Yeah.
500 or something?
yeah,
Okay, so I'm going off the rails on the deals too, but I did that in 2005, 6, and 7, and then I was hurting in 08, 9, 10, 11, 12, 13, and 14. So I can just say that, yes, when you have too much money on hand, you want to spend it, and then you make risky moves. I bought cryptocurrency, lost 30% on it. I bought some venture capital stuff, then lost money on. So I wouldn't be surprised if I buy some deals right now that are not going to do well. But at least I'm hurting cash right now, so I can go through the downturn. And I'm just saying it has the ingredients.
Yeah, to that point, I mean, and Milan mentioned it, but I'll echo it. Anytime where there's as much cap rate compression or the prospect of rent growth, the tertiary markets tend to become more attractive because, again, everyone has cash, they want to spend it. Where can you find the return? It's the DeKalbs of the world. It might be Milwaukee or St. Louis or Kansas City. So, for the investors based in Chicago that can't find a return, it may behoove you to look at some of those secondary, tertiary markets where, like a Milwaukee, 90 miles north. I know Sal Bekovic just bought 300 units up there.
Yep.
It's a similar type of asset that he manages here in Chicago, but he's getting a better return. He's got arguably an easier tenant base to manage, and he's loving it. So it's definitely a trend that happens when the market gets tight. But I still see there's a lot of deals out there in tertiary markets.
Yeah. I think that we probably should be wrapping this up soon, but I was curious, are there any questions from the audience on topics that we haven't touched upon? Anybody have any questions? Sure.
So speaking of tertiary markets, I work for an architecture firm that spans Lincoln, Nebraska to South Bend. We do a lot of multifamily in a lot of those markets. So whether it's universities, Lincoln, Cedar Rapids, Iowa City, Quad Cities, and the housing shortages in a lot of those communities, it seems like we can't build multifamily fast enough. So a couple of questions. Looking at Northwest Indiana, then expanding the railroads, to a second line, and some of the investments of the communities there. Do you think that that's going to spur multi-development along the line and within those communities to revitalize some of those cities? And what are some of the trends that you may be seeing or hearing about in multifamily development as opposed to, strictly looking at value add type of properties?
Sure, I can take the Northwest Indiana question. We've done a couple deals in Valparaiso. I actually own some property, Chesterton, LaPorte. And speaking of rent growth in those areas and just overall values, there is an incredible amount of demand from investors. One of the big reasons is because of the expansion of the South Shore Line and adding the frequency of trains up to Michigan and through into downtown Chicago. And you also see it just from people getting out of to buy a home out of Illinois and into Indiana because it's not that much farther, and your tax bill is a quarter of what it is in the Southwest burbs or wherever you're coming from. I think. Overall, I think there's a lot of demand. It used to be, 40, 50,000 a unit in those markets. They're already up to 80, 90, sometimes 100,000 a unit, depending on the asset. So I think it would certainly be a good idea to explore those markets from your perspective, because I think there's a lot of, and plus it's a very investor-friendly state, as well as a landlord-friendly state. If you have any issues with evictions, you can get them out in 30 days. It's a very efficient system, whereas, we have some issues obviously here in Illinois and certainly Cook County. So I think that market will continue to grow. I think it's gaining a lot of popularity, and certainly in the last 5 years, but even the last 2 years, it's really just gone up. I'll let someone else answer the development question.
Yeah, no, we've seen a tremendous amount of activity in Northwest Indiana, as far as even South Bend. I mean, I just was there Monday and, I think largely because of the tax-friendly nature of the state, proximity. It took me 2 hours to get to South Bend. That'll say it takes me 2 hours sometimes to get to Crystal Lake, right? I mean, we've seen a lot of activity in that market, largely because the price points and the cap rates. That's kind of valuation, kind of what we've seen.
Yeah.
Any other questions from our group? Okay, so maybe we'll just finish it with a question in terms of kind of what's your forecast for 2022? Pull out your crystal ball. Any ideas? Can we start with you, John?
Sure. I think there's enough capital that's out there that believes in multifamily investments, whether it's the cash from investors or from Jerry and lenders. That's a good sign. I think the markets in the city, you need to understand them from the north side to the south side to the west side. They all have their own issues and opportunities. The suburban market, I think, is also I'm bullish on it as well, along with Northwest Indiana, because of rental growth. The cap rate compression is there, and that's going to be a concern if the interest rates do go up in terms of those opportunities. But right now, just from a showing standpoint and a demand standpoint, there's definitely more demand than there is some supply. So I think this year is going to be pretty strong again.
Okay, anybody disagree?
No, I agree 100%. There's so much capital flowing out there, and there are very few better investments than invest real estate, specifically multifamily. I would just add one thing to keep an eye on if you're not already, because we don't hear about this as much in Chicago, but is the single family rental build-to-rent industry. It's blowing up, and I think people are still trying to wrap their arms around it as an alternative to traditional multifamily, but I expect that to become a much more attractive investment vehicle for folks going into 22.
Only thing I would add is that, we have been as busy as we were in 06, 07 in the past 2 years. We've done over, $225 million of transactions just on the commercial real estate side out of my office. And we're poised to hit our goal like first quarter, just given what's in the pipeline. So the only thing that could disrupt that are like real sharp increases in interest rates. That would definitely put the brakes on a lot of new opportunities. But we're forecasting, at least for the next 12 months, kind of more of the same and a little more. So knock on wood, that's the case.
I agree. 2022 is going to be amazing for all the wrong reasons. So it's going to be great. And the one thing I will say again is that you shouldn't make your business plan based on the market. You should make your business plan based on price per square foot.
Yeah, I mean, I agree with all the sentiment up here. As far as interest rates, I would peg the over under at maybe 50 basis points, maybe one in Q3 and maybe one bump in Q4. And I hopefully with this new variant Omicron, hopefully it starts to, I know it's affecting a lot of people right now, but hopefully it starts to die down in the next couple months. And I still think we haven't fully recovered from COVID. I mean, there's a lot of people still hesitant to go out to eat or to even travel in the hotels. And I think if we get through this come springtime or even early summer, if it takes that long, I don't see why the economy would not just take off. I mean, there's a lot of money out there, but a lot of people are spending money. And I think that will just help the entire economy and then obviously translate well to apartments, throughout the Chicago area as well as the country. So I think overall it's just going to continue. And I think, we had a record year last year. I think 2022 could very well eclipse 21.
Great. Well, I want to thank everybody for all
Thank
their
you.
insights. It was a great panel. And thank you all for participating.
Thank you, Gail.
Thank
We
you.
appreciate it.